Sanctions are rarely described as weapons, yet they reshape nations without firing a shot. Since 1979, pressure applied far from battlefields has slowly rewritten Iran's economy, its money, and its connections to the world. This story is not about morality, diplomacy, or blame. It is about a system that expands its reach until resistance adapts, distortions multiply, and control demands ever greater effort. What begins as containment evolves into dependence on shadows, loopholes, and parallel channels. To understand this process is to see how economic power functions and why it never remains one-sided for long globally today. Sanctions are commonly framed as precise tools, designed to change behavior while preserving stability. The assumption is simple: restrict access, raise costs, and the targeted system will adjust in the desired direction. In reality, sanctions invert how systems behave. Instead of producing correction, they produce adaptation, and adaptation reshapes structure rather than intent. When access to formal channels is removed, informal channels expand. When visibility increases, opacity becomes valuable. Pressure does not compress the system inward. It pushes it outward, into spaces where control is weaker. In the case of Iran, this inversion became visible early. Financial isolation did not eliminate trade. It rerouted it. Currency restrictions did not end exchange. They fractured it. Official pathways narrowed, while intermediaries, proxies, and layered transactions multiplied. The system learned to survive by becoming hard to measure. Each new restriction rewarded actors willing to operate in grey zones, gradually shifting economic activity away from transparent institutions and toward networks defined by trust, necessity, and risk. This inversion affects the imposing side as well. For the United States, sanctions require constant expansion to remain effective. A frozen account leads to secondary restrictions. Secondary restrictions require enforcement against third parties. Over time, the tool no longer targets a single economy. It binds the global financial system into compliance through fear of exclusion. Banks, insurers, and trading firms become enforcers by default, reshaping global behavior not through agreement, but through avoidance. What emerges is a paradox. The more comprehensive the sanctions, the less legible the targeted economy become. Time, 0.5s, data degrades, signals weaken, official statistics lose meaning. At the same time, the enforcing power becomes increasingly dependent on its own system of controls. Every exemption, license, and blacklist adds complexity. The system grows rigid, rule-bound, and slow to adjust. Sanctions therefore invert their stated purpose. They do not simplify choices. They multiply them. They do not clarify leverage. They diffuse it across countless actors. What appears as dominance on paper often translates into fragility in practice, because maintaining pressure requires permanent escalation. Once embedded, the system cannot easily retreat without exposing how much behavior has reorganized around its constraints. In this environment, compliance becomes performative, risk pricing replaces cooperation, and economic relationships shift from efficiency toward resilience. The system no longer asks what is optimal. It asks what can survive scrutiny, delay, and interruption without collapsing under accumulated pressure. That question quietly defines the new equilibrium. The core mechanism that turns sanctions from pressure into structural damage is overextension. Sanctions begin with a narrow objective, but they rely on financial leverage that must be continuously reinforced to remain credible. Each restriction creates incentives to bypass it, and each bypass demands an additional layer of control. Over time, enforcement expands faster than compliance. The system spends increasing energy policing behavior rather than shaping outcomes, and that imbalance accumulates quietly. In Iran's case, overextension manifested through monetary distortion. As access to foreign currency tightened, the domestic currency absorbed the shock. Exchange rates fractured into official, semi-official, and informal layers. Prices stopped reflecting productivity and began reflecting access. Inflation did not simply rise. It became uneven, accelerating faster in sectors exposed to trade restrictions and slower where subsidies or controls masked scarcity. This misallocation redirected capital away from long-term investment toward short-term preservation. Wealth flowed into assets that could move, hide, or store value rather than produce growth. Financialization deepened this effect. With traditional banking constrained, economic survival increasingly depended on intermediaries, offshore structures, and shadow networks. Transactions became more expensive, slower, and less predictable. Risk premiums embedded themselves into everyday commerce. Over time, these premiums hardened into structure. What began as a workaround became standard practice. The economy adapted, but adaptation came at the cost of efficiency and transparency. There is a critical delay embedded in this process. Structural damage accumulates long before it becomes visible. Early stages may show resilience. Trade volumes recover through alternative routes. Revenues stabilize through discounting and rerouting. This creates the illusion that sanctions are manageable. In reality, the system is borrowing stability from the future. Infrastructure deteriorates. Talent migrates. Capital avoids long horizons. By the time decline becomes undeniable, reversal requires dismantling entire layers of adaptation that have become embedded. The enforcing system experiences a parallel mechanism. As sanctions expand, enforcement agencies rely increasingly on compliance from private actors. Banks, shipping firms, and insurers become extensions of policy. This shifts risk onto institutions that were not designed to manage geopolitical uncertainty. To protect themselves, they overcomply, cutting ties even where legal pathways exist. This amplifies fragmentation beyond the original target, constraining global flows more broadly. Misallocation is the final link in the chain. Resources flow not to their most productive use, but to their safest legal position. Innovation slows, efficiency declines, complexity rises. Both sides operate within systems that reward caution over performance. Over time, the economic battlefield hardens into a landscape where flexibility is punished and deviation is costly. The collapse mechanism is therefore not a single break, but a gradual locking in of inefficiencies. Sanctions do not collapse economies directly. They freeze them into suboptimal configurations that degrade resilience from within. The damage compounds silently, long after headlines fade and attention moves elsewhere. History offers repeated examples of systems that attempted to control rivals through economic exclusion, only to discover that exclusion reorganizes behavior rather than eliminating it. Long before modern sanctions, empires relied on blockades, trade prohibitions, and financial isolation to weaken adversaries. The pattern was consistent. Initial disruption produced leverage. Sustained pressure produced adaptation. Adaptation produced parallel systems that eventually reduced the effectiveness of the original tool. In the late 19th century, imperial trade restrictions were used to discipline colonies and competitors alike. Tariffs and access controls were meant to bind peripheral economies to the center. Instead, they encouraged smuggling networks, alternative currencies, and regional trade blocs that operated beyond official oversight. These shadow systems were inefficient, but they were resilient. Once established, they proved difficult to dismantle, even when formal restrictions were later eased. A similar pattern emerged during the interwar period. Financial sanctions and currency controls were imposed to stabilize fragile monetary systems and contain political threats. Rather than restoring order, these measures fragmented global trade. Nations developed bilateral, clearing arrangements, barter agreements, and controlled exchange regimes. Official currencies lost credibility. Informal valuation replaced market signals. Economic activity continued, but it moved into channels that prioritized survival over integration. The global system did not collapse immediately. It hardened into compartments that no longer trusted one another. Energy provides another historical blueprint. Attempts to restrict access to critical resources have repeatedly produced unintended consequences. When dominant powers sought to limit supply or control pricing, targeted states invested heavily in alternative routes, substitutes, and alliances. These responses were costly and inefficient, but they reduced vulnerability over time. Control achieved through restriction proved temporary. Adaptation proved durable. The lesson from these cases is not that sanctions fail. It is that they transform systems in predictable ways. Pressure accelerates the creation of redundancy. Redundancy reduces efficiency. Reduced efficiency lowers transparency. Lower transparency weakens central oversight. What begins as a strategy of dominance evolves into a landscape of partial visibility and contested control. Iran's experience fits squarely within this historical pattern. Decades of sanctions did not isolate the economy into inactivity. They reshaped it into a hybrid structure, combining formal institutions with informal networks. Oil exports did not disappear. They were rerouted. Financial flows did not stop. They were fragmented. Each layer of restriction added another layer of mediation, cost, and opacity. At the same time, The enforcing system mirrored these dynamics. Financial centers expanded compliance frameworks, surveillance mechanisms, and reporting obligations. These tools increase control in the short term, but reduce flexibility in the long term. Time, 0.5s. Decision-making slowed. Risk aversion increased. Institutions became less willing to engage in complex environments, even when engagement was legal. This produced a chilling effect that extended beyond the original target. Historically, such conditions persist until a structural transition occurs. Either the restrictions are lifted and the accumulated distortions unwind slowly, or the parallel systems mature into semi-permanent alternatives. In neither case does the system return to its original state. Adaptation leaves scars. Trust erodes. Path dependence sets in. The historical blueprint therefore warns against expecting clean outcomes. Economic pressure rarely produces decisive resolution. It produces reconfiguration. The longer pressure persists, the deeper the reconfiguration embeds itself. By the time policy shifts, the system has already learned to function under constraint, and reversing that learning becomes as complex as the sanctions themselves. This pattern has repeated across centuries, technologies, and political contexts. It is not unique to any nation or era. It reflects how complex systems respond when access is restricted, but survival remains necessary. Control invites adaptation. Adaptation reshapes structure, and structure, once altered, resists returning to its prior form. The stage-by-stage pattern begins with targeting and signaling. Sanctions are first introduced as a message rather than a barrier. The goal is to demonstrate capability and intent, not yet to sever flows. Financial institutions observe the initial listings, designations, and restrictions, and begin adjusting behavior preemptively. Even limited measures alter expectations. Risk assessments change. Transactions slow. The system absorbs the signal before the substance arrives. The second stage is compliance expansion. As restrictions solidify, enforcement relies on broad participation. Bank, time, 0.3s, insurers, shipping firms, and clearing intermediaries are required to screen, report, and avoid. Compliance costs rise. Institutions respond by simplifying exposure, withdrawing from complex jurisdictions, and reducing discretionary engagement. This creates the first layer of collateral impact. Legitimate activity becomes harder to execute, even where exemptions exist. Economic friction increases without a formal cutoff. The third stage is rerouting. Targeted actors seek continuity rather than confrontation. Trade is redirected through intermediaries. Ownership structures are layered. Payments are broken into smaller segments, delayed, or denominated indirectly. The system learns where scrutiny is weakest and concentrates activity there. Each reroute increases transaction cost and reduces transparency, but preserves flow. At this stage, official statistics begin to diverge from reality. The fourth stage is institutional erosion. Domestic financial institutions lose access to correspondent relationships and international liquidity. Their role contracts. Informal mechanisms fill the gap. Trust replaces regulation. Personal networks substitute for standardized processes. This does not eliminate finance. It personalizes it. Power concentrates among those able to manage risk, secrecy, and enforcement exposure. Economic inequality deepens as access becomes uneven. The fifth stage is normalization of distortion. What began as an emergency response becomes routine. Parallel exchange rates stabilize. Discounted trade becomes standard. Sanctions premiums embed into pricing. Businesses adapt business models to survive within constraints rather than waiting for relief. The economy functions, but not efficiently. Productivity gives way to resilience. Growth gives way to preservation. The sixth stage is enforcement escalation. As adaptation reduces effectiveness, new measures are introduced. Secondary restrictions expand reach to third parties. Penalties increase. Monitoring intensifies. This restores some leverage temporarily, but at higher systemic cost. Global institutions face greater compliance burdens. Smaller actors exit. Concentration increases. The financial system becomes less diverse and more brittle. The seventh stage is global spillover. Risk avoidance extends beyond the target. Entire regions or sectors are deemed too complex. Trade. Corridors shrink. Financing gaps widen. Energy markets fragment. Price signals lose clarity as transactions reflect legal exposure rather than supply and demand. The sanctions regime becomes a factor shaping global allocation, not just bilateral relations. The eighth stage is rigidity. Both sides become locked into position. The targeted system has invested heavily in adaptation and cannot easily reintegrate. The enforcing system has embedded sanctions into law, compliance frameworks, and institutional practice. Reversal becomes politically and operationally difficult. Flexibility declines. The cost of change raise. Time 0.5s. The final stage is transition pressure. Over time, accumulated inefficiencies strain resilience. Maintenance consumes increasing resources. Younger talent migrates. Capital avoids long commitments. The system does not collapse abruptly. It thins. Capacity erodes. At the same time, alternative arrangements mature outside the original framework. They are imperfect, but they reduce dependence. The balance of leverage shifts gradually, often unnoticed. This stage-by-stage progression explains why sanctions rarely achieve decisive outcomes. They excel at disruption over time 0.3s, but struggle with resolution. Each stage solves the problem of the previous one while creating new constraints. The system advances not toward equilibrium, but toward entrenchment. By the end of the sequence, behavior has been permanently altered on all sides. Understanding this pattern is essential, because it reveals where power accumulates and where it dissipates. Leverage exists early, when adaptation has not yet occurred. Later, leverage becomes expensive and indirect. The system continues to function, but under a different logic. Control is replaced by management. Pressure is replaced by maintenance. And the original objective fades beneath the weight of the structure built to pursue it. This is not a failure of policy. It is a predictable outcome of how complex economic systems respond to sustained constraint. Each stage follows logically from the previous one. Once initiated, the sequence is difficult to interrupt without accepting the costs already embedded. The longer the pattern runs, the more durable it becomes. In the modern financial system, sanctions against Iran operate within an environment far more interconnected than any historical precedent. Digital banking, instantaneous settlement, and centralized clearings have compressed distance and time. This integration amplifies the reach of restrictions, but it also amplifies the consequences of their misuse. When access is denied at a central node, the effects propagate outward across networks that were designed for efficiency, not resilience. The contemporary alignment begins with the dominance of the dollar-based system. Most international trade, energy pricing, insurance contract, time, 0.3s, and reserve holdings depend on dollar settlement and institutions operating within United States jurisdiction. This concentration provides unparalleled leverage. Exclusion from this system does not merely inconvenience a target. It restructures incentives across the entire network. Firms calculate exposure not just to markets, but to regulatory interpretation. Legal risk becomes as significant as economic risk. For Iran, this alignment means that sanctions are not experienced as isolated prohibitions. They function as an environmental condition. Every transaction is evaluated through the lens of potential secondary exposure. Oil exports, for example, do not end. They adjust. Volumes fluctuate. Discounts deepen. Buyers change. Shipping routes lengthen. Insurance coverage becomes conditional. Each layer adds friction, but the trade persists because global demand for energy remains. The system adapts by absorbing inefficiency rather than eliminating exchange. This adaptation increasingly relies on intermediated structures. State entities coordinate with private actors. Trading houses emerge to manage complexity. Financial flows are segmented, delayed, and disguised through legitimate but opaque mechanisms. None of this violates the fundamental logic of commerce. It simply reflects a shift in priorities from speed and transparency toward survivability. The modern system allows this because its scale provides room to maneuver. Complexity becomes camouflage. On the enforcing side, alignment manifests as institutionalization. Sanctions regimes are codified into law, embedded in compliance software, and operationalized by private institutions. Banks are required to know not only their customers, but their customers' customers. Shipping firms must track ownership chains. Insurers must evaluate geopolitical exposure. The result is a system where risk management extends beyond traditional financial metrics into political interpretation. This creates a subtle but significant shift. Decision-making moves away from market assessment toward legal defensibility. Transactions are rejected, not because they are unprofitable, but because they are ambiguous. Ambiguity becomes toxic. This drives consolidation, as larger institutions with compliance capacity dominate. Smaller firms exit. Innovation slows. The system becomes safer in appearance but less adaptable in practice. The global financial architecture absorbs these changes unevenly. Regions less integrated into dollar settlement face fewer direct constraints, but greater indirect costs. They operate in parallel, using alternative currencies, clearing arrangements, and barter-like structures. These mechanisms are less efficient, but they reduce exposure. Over time, familiarity increases. Infrastructure develops. What begins as a workaround gains permanence. Energy markets illustrate this alignment clearly. Sanctions reshape pricing rather than supply. Discounts compensate for risk. Long-term contracts replace spot markets. Transparency declines as transactions move off public exchanges. Official data becomes less reliable. Analysts infer flows indirectly. This opacity reduces the effectiveness of policy signals. Markets respond to perceived enforcement risk rather than actual scarcity. For the United States, maintaining this system requires constant calibration. Enforcement must remain credible without triggering widespread disengagement. Each escalation risks accelerating diversification away from centralized nodes. Yet, restraint risks normalization of circumvention. The system balances on a narrow ridge, where control depends on confidence that access remains valuable and exclusion remains costly. Modern alignment therefore reveals a structural tension. The same integration that enables sanctions to function also magnifies their systemic impact. The more central the system becomes, the more pressure it exerts on itself. Global actors adapt not out of defiance, but prudence. They seek optionality. They reduce single-point dependencies. These choices accumulate quietly, reshaping the system from within. This alignment does not signal imminent collapse. It signals transformation under strain. The financial system continues to function, but its priorities shift. Efficiency yields to redundancy. Openness yields to screening. Cooperation yields to compliance. Time 0.5s. These are rational responses to sustained constraint. They are also costly. Understanding modern system alignment is essential because it shows where leverage truly resides. Not in any single sanction or exemption, but in the architecture that makes compliance preferable to avoidance. As that architecture becomes more burdensome, actors weigh alternatives more seriously. Over time, alignment drifts. The system remains dominant, but less exclusive, powerful, but less singular. This is the quiet effect of prolonged economic pressure. It does not produce headlines. It produces gradual reorientation. By the time it becomes visible, it has already reshaped incentives, institutions, and expectations. The system has adapted, not broken, and adaptation, once embedded, defines the next phase of the pattern. Acceleration occurs when a system under constraint loses its ability to adjust incrementally. In the case of prolonged sanctions, this moment is not marked by a single decision or crisis, but by the accumulation of rigidity. Flexibility erodes quietly. Policy options narrow. Each response becomes more costly than the last, and the system begins to react rather than steer. For Iran, acceleration emerges from the exhaustion of adaptation. Informal networks expand only to a point. Discounted trade can sustain revenue, but it cannot fully replace long-term investment. Infrastructure ages. Maintenance is deferred. Time. My fives. Human capital seeks stability elsewhere. These pressures do not explode suddenly. They compress the system's margins. When shocks occur, whether through commodity price swings, enforcement tightening, or regional disruption, the system absorbs less and transmits more. Triggers in this environment are often external but ordinary. A change in enforcement posture, a shift in energy demand, a regulatory reinterpretation by a major financial institution. Because buffers have thinned, these events produce outsized effects. Exchange rates move sharply. Liquidity dries up. Informal. Channels seize temporarily as trust recalibrates. The economy does not collapse, but it stutters, revealing how dependent it has become on continuous workaround functioning. Acceleration also operates on the enforcing side. Sanctions regimes accumulate legal and administrative weight over time. Each new measure must align with existing frameworks. Each exemption requires justification. Decision cycles lengthen. This creates delay in response to changing conditions. When rapid adjustment is needed, the system struggles. Over time, Enforcement becomes procedural rather than strategic. A critical trigger zone forms when escalation and fatigue coexist. Additional pressure yields diminishing returns, yet withdrawal carries reputational and political cost. The system becomes trapped between action and inaction. Maintaining the status quo requires constant effort. Altering it risks destabilization. This condition accelerates drift toward informal accommodation, selective enforcement, and quiet exceptions. Globally, acceleration manifests as cautious disengagement. Firms diversify exposure. States explore alternative settlement mechanisms. Energy buyers accept opacity in exchange for reliability. None of these choices challenge the system. Openly, they hedge against it. The cumulative effect is subtle, but persistent. Central nodes remain powerful, but marginal influence declines. Acceleration does not announce itself as crisis. It appears as reduced responsiveness. The system still functions, but with less grace. Errors compound. Small misalignments produce larger consequences. The space for correction shrinks. In sanctions-driven systems, the trigger is rarely a dramatic failure. It is the moment when maintaining control requires more resources than the control yields. At that point, adaptation elsewhere outpaces enforcement at the center. The pattern moves toward exposure, not collapse, but visibility increases. The costs that were once hidden become harder to ignore. This zone defines the transition from managed pressure to structural strain. What follows is not resolution, but recognition of who bears the weight of accumulated constraints. The consequences of prolonged sanctions are unevenly distributed, and that unevenness defines their political and economic legacy. The immediate burden falls on households and small firms, not because they are targeted, but because they lack insulation. Currency instability translates into rising living costs. Access restrictions raise prices quietly through intermediaries. Ordinary transactions absorb layers of risk premium that are invisible but persistent. Over time, the population adapts by lowering expectations rather than improving opportunity. Within Iran, exposure concentrates along fault lines of access. Those with connections to trade network, time 0.3s, state coordination, or capital mobility retain options. Those without become more vulnerable to inflation, shortages, and volatility. The economy continues to function, but inequality hardens. Opportunity becomes conditional. This erosion does not require collapse. It operates through normalization of constraint. Globally, exposure extends beyond the target. Firms operating legally withdraw due to uncertainty. Regions reliant on energy imports face price distortions. Financial institutions assume compliance costs that reduce lending capacity elsewhere. The system absorbs these costs, diffusely, making them harder to attribute directly to policy. Responsibility fragments. Accountability fades. Sanctions therefore externalize cost in multiple directions. They weaken the targeted economy's social fabric while quietly taxing the global system through friction, delay, and risk aversion. No single actor bears enough cost to force immediate change. Instead, strain accumulates across layers, visible only in aggregate. This exposure sets the stage for the final recognition. Sanctions do not end systems. They redistribute pressure until adaptation becomes permanent. Sanctions against Iran reveal a broader pattern of economic power. Systems built on exclusion generate adaptation, and their adaptation reshapes structure more reliably than intention. Control achieved through financial dominance carries its own maintenance cost, one that grows over time and constrains flexibility. The outcome is not collapse, but transformation under pressure. The targeted system survives by becoming opaque and resilient. The enforcing system remains dominant by becoming procedural and rigid. Both change. Neither returns to its previous state. History shows that timing is uncertain, but sequence is not. Once pressure embeds itself into structure, reversal becomes complex and costly. What matters is not when adjustment occurs, but how deeply systems have reorganized before it does.